Welcome back everyone, I hope you're having a great day, and in this episode we're going to take a look at 3 of the best dividend kings you can buy right now that have recession-proof operations and will continue to pay out growing dividends through any tough economic conditions. If you've logged on to any stock market news website over the past few weeks, you've been bombarded with different headlines saying a recession is coming in 2023 or into 2024. So in this episode, we're going to take a look at some of the strongest dividend kings on the market that have consistent operations through any economic period and will continue to provide their shareholders with some growing passive income quarter after quarter. And for each of the 3 companies we're going to go over, we're going to take a look at their recent financial performance, their current valuation, and the current dividend status as well. So please hit that like button and subscribe if you already haven't done so. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and of course we also track the progress of my personal dividend growth portfolio as well. And I actually own all 3 of these companies in my personal portfolio, so I put my money where my mouth is when it comes to making these videos. So now we're going to transition into the first dividend king you can buy right now that has very strong recession-proof operations, and that is ticker PEP for PepsiCo, one of the largest food and drink companies on the planet. They currently trade for $168 per share, up around 2.4% on the 1-year chart. They have a market cap at $233 billion, with a nice starting dividend yield right now at 3% and a forward PE ratio of 22.6. And with Pepsi, this is a company that has shown very strong financial results even through our most recent recessionary periods. If we take a look at their performance back in 2007 through 2009, Pepsi lost 35% of their value, meanwhile the S&P 500 lost 55% of the value throughout that same recessionary period. So 2008 was a terrible time for the market, but Pepsi actually outperformed by 20% during that period. And of course, during the 2008 recession, when many companies lost 20, 30, 40% of their top line sales, Pepsi's sales just dipped a mere 0.5% overall throughout that entire period. So because of their diverse product mix in the food and beverage categories, which consumers still have needs for even throughout a recession, Pepsi's sales saw a slight minimal decline throughout one of the worst recessions of our recent history. So if we take a look at that diverse product mix, they have over 20 different lines of beverages and snack foods that generate over $1 billion in annual revenue, meaning the company is not solely reliant on a single product line or category in order to grow and maintain the business. And if we take a look at a breakdown of their top line revenue, 58% comes from their snack food products, where they're the leader in the savory snack industry, and the remaining 42% comes from their beverage lines, where globally they are number 2, just behind Coca-Cola. And if we take a look at the income statement, year over year, this company continues to expand total revenue. $64 billion back in 2018, up to $67, $70, $79, $86, and in the trailing 12 months, this company has generated more than $90 billion of total top-line revenue. $90 billion up from 64 just 4 or 5 years ago. So for a big dividend king company like Pepsi, which often gets overlooked because of how large and well established they are and not really considered to be growing, this company has seen top line revenue expansion year after year, which is great to see. And taking a look, going forward, this company still has a lot of room to continue to grow. In the convenient food market, globally, that's a $600 billion industry with a CAGR of 5%, and Pepsi right now still only makes up 8% share of that total industry. So going forward, there's still a lot of opportunities to expand their market share and grow top-line revenue at a significant rate. And same with the beverage industry, they have a 9% market share right now, with much room to grow and acquire other businesses and expand this market share over time. Taking a look, this company's current dividend also sits at 3%, so you can buy in today and get a nice starting yield. They pay out just over $5 per share per year, with a nice manageable 65% net income payout ratio and a 5-year dividend CAGR right below 7%. And with this company, they are a dividend king. They have now had 51 straight years of dividend increases. Since 2010, the dividend CAGR is at 7.7%. And the company, along with paying out this growing dividend year after year, they are doing share buybacks. The company does buy back a minimal amount of shares each year, so as you continue to own the company, you're getting more and more ownership in the underlying business, helping the EPS numbers grow as well. And the dividend payment you receive from Pepsi every single quarter is considered to be very safe from Simply Safe Dividends. The company has a dividend safety score of 93, meaning it's highly unlikely we see a dividend cut coming from Pepsi anytime soon. So this company is the first dividend king we're taking a look at for your portfolio if you have fears of an upcoming recession. They have a nicely diversified product mix and actual products that are in demand from consumers regardless of the economic period. Through good and bad times, consumers need to eat and drink, and PepsiCo products are go-tos in supermarkets all around the world, so definitely a stock to take a look at. And now if we move on into the second recession-proof dividend king, we have ticker PG for Procter Gamble, another consumer staple company that has a large diversified product mix that we're going to take a look at. Currently, the company trades for $145 per share, and over the past year, they are up over 10%. They have a market cap at $344 billion, a nice starting yield at 2.5%, and trading with a forward PE ratio of 22.8. And Procter & Gamble is very similar to Pepsi in many ways. They share very similar business structures, but the company also has a history of outperforming the market through our most recent recessionary periods. Taking a look at back in the 2008 performance, Procter & Gamble lost 36%, meanwhile the S&P 500 lost that 55% in value, meaning Procter & Gamble outperformed the market by 19% during that tough period. And again, similar to Pepsi, how they operate is they act as the holding company or the top of the umbrella, and they own dozens of different individual product lines across many different consumer categories, and they currently have over 20 individual billion-dollar brands that boast the number 1 or number 2 position in the market in their respective category. And if we take a look at their diversified portfolio, they split their performance across 10 different consumer categories, which include baby care, feminine care, family products, fabric, home, hair, skincare, grooming, oral, and personal health care. And of course, with a portfolio this diversified across every area of consumers' needs, you have daily use products that are continually needed and in demand through every recessionary environment. And one thing I like about P&G is their products do run out. All of these products on the screen, people have to continually buy them as they run out. They are useful products that do not last for years. They last for a week, 2, maybe a month at most, and consumers are recurring customers for these individual products. And across the entire product mix, all 10 of these consumer categories have seen organic sales growth throughout 2023. Procter & Gamble is still growing top-line revenue across all 10 of their individual product categories, ranging from a minimal 2% growth all the way up to a very rapid 16% sales growth in the personal healthcare industry. So again, very similar to Pepsi, not solely reliant on a single category or product line in order to function and grow the business. And of course, if we take a look at these growing sales and jump over to the income statement, year over year, this dividend king that's been around for over 120 years in operation still continues to generate growing revenue each and every year. $67 billion of total sales back in 2019, up to over $82 billion of total revenue in the trailing 12 months. So they continue to expand new product mixes, make acquisitions, and grow top-line sales through price increases and growth in market share as well. And if we take a look at their dividend history, they've been making dividend payments for 133 consecutive years. 133 consecutive years, this company has not missed their dividend payments. They've been growing that dividend for 67 consecutive years as well, making them a well-established dividend king. They do a great job of converting their free cash flow, and over the past 10 years, through the form of dividends and share buybacks, they've returned over $141 billion to their investors. $141 billion of cash via dividends and share buybacks has been returned to investors during the past decade, which is absolutely astounding as the company's current market cap is only at $344 billion, meaning over a third of their current market cap has been paid back in the form of dividends and share buybacks only during the past 10 years to their shareholders, which is absolutely impressive. And right now, if you buy the company, your starting yield will be at 2.5%, a dividend per share per year of $3.76, payout ratio of 62% as well. And this company has the highest dividend safety score possible, coming in at that 99, meaning this company's dividend is extremely safe and unlikely to be cut anytime soon. Very similar to Pepsi and the third dividend king we're going to move on to next. So P&G is stock number 2, and we're going to transition right into the third and final dividend king you should take a look at for your portfolio if you're worried about an upcoming recession, and that is ticker J&J for Johnson & Johnson. The company currently trades for $155 per share. They're down 5.7% on the 12-month chart. They have a $377 billion market cap, current dividend yield at 3%, and a very, very low forward PE ratio of only 15.6. J&J is one of the world's leading pharmaceutical companies and maker of medical devices. They have a large portfolio of different products that all generate over $1 billion in top-line revenue. And with this company, regardless of the recessionary environment, whether if the economy is good or bad, if an individual or a consumer has an underlying health condition, they will need to continually spend the money on their different medical devices or pharmaceutical product, regardless of what's going on in the economy. So they have a very stable and growing income stream from products that are in demand in all economic periods. And back in 2008, this company actually had the strongest performance of the three stocks we've gone over, losing 27% of their value compared to the S&P 500's 55% drop, meaning this company outperformed the market by 28%, absolutely incredible outperformance through a very tough recessionary period. And if we take a look at the company's stats, they are still growing as well. 25% of sales came from products launched in the last 5 years. So although this is a legacy business, they continue to develop new products each and every year that are making up a significant portion of the total revenue, 25% of the sales from newly launched products. They're currently having organic sales growth of around 8% on average over the past 20 years, with EPS growth right at 8% per year on average as well. And more than 70% of their revenue comes from products who hold the number 1 or number 2 position in their respective category. Again, market-leading products currently served to consumers all around the world. Their 12-year total return on average each year is 12.7%. So of course, over the past decade, you're going to average 12.7% with the share price appreciation and that compounding dividend. They have increased that dividend payment for over 60 consecutive years, and they have a AAA rated balance sheet, one of the best rated balance sheets in the entire stock market right now. Of course, this is a free cash flow machine as well. Total free cash flow over the past 5 years is right around $96 billion, and they've returned over 60% of that free cash flow to shareholders in the form of dividend and stock buybacks. And of course, we can see here 29 individual platforms or products that generate over $1 billion in annual sales. So again, this company is hitting on all different factors: organic sales growth, EPS growth, strong total returns, growing dividends, sales coming from new products. Overall, this legacy business that has been around for over a century has still been performing very strong as of late. If we take a look at the income statement, total sales of $81 billion back in year-end 2018 has now grown to over $97 billion in the trailing 12 months. And if we take a look at the dividend payment, starting yield right around 3% today, payout ratio of only 44% of their net income, so very safe, very stable payout ratio with room to grow that dividend payment, and a 5-year dividend CAGR right around 60%. And similar to Procter Gamble, this company has the highest dividend safety score possible, coming in at a 99, so a very safe dividend, very strong balance sheet, and this payment is expected to grow for many decades going forward as well. So Johnson & Johnson, PepsiCo, and Procter Gamble were the 3 dividend kings worth taking a look at for your portfolio in the current market environment. If you believe all the headlines, if you have fears of an upcoming recession, you may want to strengthen up your portfolio and do some research into companies who have a strong history of performing well during recessionary environments, who have strong portfolios of products that will continue to be in demand and generate growing revenue even through economic collapses, which all 3 of these companies do. And of course, you just want well-established businesses that have good management teams that know how to fight through any tough economic conditions and come out on the other side in a very strong position. So overall, PepsiCo, Procter Gamble, and Johnson & Johnson, 3 dividend kings you can buy right now for some growing passive income. Definitely worth taking a look at. So thank you for watching the video all the way to the end, and I will see you in the next video.